What if I told you that selling your stocks in retirement might actually be one of the most expensive decisions you ever make? Most people assume that when they need cash in retirement, they have to sell something. But there's a strategy that wealthy investors have quietly used for decades, and more everyday retirees are discovering it. It's called borrowing against your stocks instead of selling them. Today, I'm going to walk you through exactly how it works, when it makes sense, and the real risks you absolutely need to know before you try it. Here's a scenario that plays out more often than you'd think. You're 63 years old. You have $400,000 sitting in a taxable brokerage account, money you've been building since your 40s. You need $50,000 for a home renovation, a medical expense, or maybe to bridge the gap before your Social Security kicks in at 67. So you sell $50,000 worth of stock. Simple enough, right? Not quite. Because if that stock has grown significantly over the years, you've just triggered a capital gains tax bill. If you've held those shares for more than a year, you're looking at long-term capital gains rates, 15% for most retirees, and potentially 20% if your income is higher. On $50,000 of gains, that could be $7,500 or more, gone immediately. And here's the part that stings even more. Once you sell those shares, they stop growing. That $50,000 that could have compounded for another 10 or 20 years? It's gone. Many people don't realize that the cost of selling isn't just the tax bill today. It's also the future growth you permanently give up. That's the hidden price of selling. So what's the alternative? This is where a securities-backed loan, sometimes called a pledged asset line or a margin loan, comes in. Here's the basic idea. Instead of selling your stocks, you use them as collateral to borrow cash from a brokerage or bank. Your investments stay fully invested. They keep growing. You get the cash you need, and you don't trigger a single dollar of capital gains tax because you haven't sold anything. Think of it like a home equity line of credit, except instead of pledging your house as collateral, you're pledging your investment portfolio. Major brokerages like Schwab, Fidelity, and Merrill Lynch all offer some version of this. The loan amounts are typically based on a percentage of your portfolio's value, often 50% to 70% depending on what you own. So if you have a $400,000 portfolio of diversified stock funds, you might be able to borrow $200,000 to $280,000 against it. You don't have to borrow that much, of course, but that's your ceiling. Interest rates on these loans can be variable, and they've fluctuated quite a bit in recent years. As of 2024, many securities-backed lines sit somewhere between 6% and 9%, depending on the lender and loan size. That's not free money, but compared to the permanent cost of selling appreciated stock, it can absolutely make financial sense. Let me give you a concrete example so this really lands. Suppose you're 65, retired, and you need $80,000 to help your daughter with a down payment on her first home. You have $500,000 in a taxable account, mostly index funds you've held for 20 years, with a very low cost basis. If you sell $80,000 worth of that portfolio, maybe $70,000 of it is pure gain. At a 15% capital gains rate, you'd owe $10,500 to the IRS. Instead, you take out a securities-backed loan for $80,000 against your portfolio. Your stocks stay put. If your portfolio grows at 7% annually, that $80,000 worth of stock you kept invested could be worth over $157,000 in 10 years. Now, you do owe interest on the loan. At 7% interest, borrowing $80,000 for 1 year costs about $5,600. If you pay it back within a year or two using income from Social Security, a pension, or part-time work, your total interest cost might be $8,000 to $11,000. Compare that to the $10,500 in taxes you would have paid immediately, plus the lost compounding on $80,000 over a decade. In many cases, borrowing wins. Not always, but often enough that it deserves serious consideration. Now, this isn't a one-size-fits-all solution. There are specific situations where borrowing against your portfolio really shines. First, it works best when you have highly appreciated stock, meaning a big gap between what you paid for it and what it's worth today. The bigger that gap, the more painful it is to sell and the more attractive borrowing becomes. Second, this strategy makes a lot of sense for short-term cash needs, not long-term, ongoing expenses. If you need a bridge, say you're waiting for Social Security to start, or you're between real estate transactions, or you have a one-time large expense, that's a great use case. Third, it's particularly valuable if you're in a high-income year. Maybe you did some consulting work, sold a rental property, or took a large IRA distribution. Layering capital gains on top of that could push you into a higher bracket. Delaying the sale, or avoiding it entirely, keeps your taxes lower. Takeaway here. If you have a taxable brokerage account with appreciated positions, and you have a short-term cash need of 1 to 3 years, talk to your financial advisor about whether a pledged asset line could save you a significant amount in taxes. I want to be very direct with you here, because this strategy has real risks, and I'd be doing you a disservice if I glossed over them. The biggest risk is a margin call. If the market drops significantly, say your portfolio falls 30 or 40%, your brokerage can demand that you either repay part of the loan immediately or deposit additional assets. If you can't do that, they have the right to sell your investments for you, potentially at the worst possible time. We saw exactly this happen to some investors during the 2008 financial crisis, and again during the 2020 COVID crash. This is not a theoretical risk, it's real. Second risk, interest rates can rise. These loans are often variable rate, meaning what starts at 6.5% today could be 9% or 10% in a rising rate environment, like we saw between 2022 and 2023. If you're not generating enough income to service the loan, the debt compounds against you. Third, this strategy only works with taxable brokerage accounts, not your 401k, not your traditional IRA. You can't pledge tax-deferred retirement accounts as collateral. The golden rule here is this: never borrow more than 30% to 40% of your portfolio's value. That buffer gives you room to survive a significant market decline without triggering a forced sale at the worst time. If you're curious whether this could work for your situation, here's how to move forward in a practical way. Start by looking at your taxable brokerage account, not your IRA or 401k, but accounts you hold at a brokerage that are funded with after-tax dollars. Log in and check your cost basis. Most major brokerages display this right in your account. If you have positions where the current value is significantly higher than what you paid, say, double or triple, those are candidates. Next, call your brokerage and ask specifically about a securities-backed line of credit or pledged asset line. Ask for the current interest rate, the loan-to-value ratio they offer on your specific holdings, and, very importantly, what their margin call policy is and at what threshold they would trigger it. You can also consult a fee-only financial advisor, someone who charges a flat fee or hourly rate and doesn't earn commissions. They can model out the after-tax comparison for your specific situation. And remember, you don't have to use the full line of credit. Even a partial draw, borrowing $30,000 or $40,000 for a defined period with a clear repayment plan, can save you thousands in taxes while keeping your portfolio intact and compounding. Let's bring this together. You've spent decades building your investment portfolio. Every share you own represents years of saving, discipline, and patience. Selling those shares, especially when you don't have to, can cost you in two ways: a tax bill today and lost growth for years to come. Borrowing against your portfolio isn't the right move for everyone, and it's not something you should do without a clear repayment plan. But for the right person, at the right time, it can be a genuinely powerful tool. It lets you access cash without disrupting your long-term financial plan. It lets your investments keep doing what they're supposed to do: grow. And it gives you more control over when and how you pay taxes. Many people who discover this strategy wish they'd known about it sooner. If you have a taxable brokerage account, appreciated investments, and an upcoming cash need, This conversation is absolutely worth having with a qualified financial professional. Your future self will thank you for thinking one step ahead. If this strategy is something you want to explore further, the next step is reviewing your own brokerage accounts and understanding exactly what you own and what it cost you. And if you're wondering how this fits alongside your Social Security timing, your Medicare planning, or your overall retirement income strategy, I've covered all of those topics in depth right here on this channel. Take a look at the videos on screen. They're designed to work together to give you a complete picture of your retirement plan. You've worked hard to get here. Let's make sure every dollar you've saved works just as hard for you.